Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Julian Emanuel of Evercore writing, the increased probability of a bubble scenario gives the S&P 500 a 30% chance to rise to 9K by year-end 2026. Julian joins us now for more. Julian, good morning.
Good morning.
It's good to see you, sir. Let's put some meat on those bones. 30% chance of 9K next year on the S&P.
So if you think about it, actually going back to Y2K, right, where all this sort of talk of bubbles originated, over the course of this last 25 years, you have had numerous bubbles: housing, global bond markets, Chinese equities in 2015, meme stocks, this, that, and the other. And frankly, when you add all that up, first of all, academia would tell you that those many bubbles in 25 years is absolutely impossible. But when you think about it, it really does speak to the fact that, number one, each bubble was larger than the last. And from our point of view, when you think about Y2K at 28 times earnings peak, it's very reasonable to think about 30 times a $300 number, getting you to 9,000 in the S&P 500. But it's bigger, more, grander every time.
Well, let's speak to this moment. There are whiffs of vendor financing. We see NVIDIA investing in some of their companies and in some of their customers, and we know that money's going to come back to their company. What's different about this moment? It seems to be the strength of the balance sheets compared to where we were in the late 90s and the absence of leverage on those balance sheets of some of the major tech players. Does that give this more legs? Is that how you think about things?
Well, again, when you think about the late 90s, you were having companies that didn't have earnings, that had barely had revenues, that were doing all the spending on CapEx. You don't have it this time. Most of the companies, to your point, have incredibly strong balance sheets. But when you think about what we've heard in the last couple of weeks, the memory for us is this Japanese phrase, karetsu, cross-shareholdings. You saw it in the 1980s and the early 1990s, which inflated valuations into the Japanese equity market bubble. And look, if you're not concerned about the potential knock-on effects of all this kind of cross-shareholder relationships, you're probably not paying sufficient attention.
So is this bullish or bearish? You're talking 9,000, which sounds great, let's get in, and then you're talking about a bubble that's bigger than anything we've ever seen before.
And you have to think about it in terms of cycles, okay? What we have been very plain about in getting ourselves around the idea that you invest in a higher valuation environment is this notion that what ends structural bull markets, and to be very clear, what we had in February to April was a cyclical bear market in a structural bull market. What ends structural bull markets is a Fed that's going to be hostile. If anything, the Fed is going to be perhaps too friendly to the point about stoking inflation. Higher yields on the long end. Amazing how quiescent the 10-year yield has been. And then, recession, that doesn't seem to be in the cards. But the last thing, the fact that every one of these capital market cycles has ended with an incredibly robust corporate action pipeline, and we're just starting to see that form, tells you that there's further to run. And as difficult as it is, and it is difficult to invest in these valuations, we think that you need to stay invested.
You need to stay invested in the big tech players. Does it say anything about the rest of the market, or is that just a completely different story in terms of the economic drivers, the areas outside of AI?
Well, look, and again, when you think about the demographics, and know that over the course of the coming decades, demographics are going to be a headwind, and they already are in places like China. That's part of why AI has had the impact that it's had. And this year we're seeing other companies, the adopters and the adapters, really start to talk about how they're essentially driving revenue. We always knew the cost-saving story, but that is very, very vital. And for us, when you look at the internals of the market, what's different between now and the late 1990s is that day to day, the advancers are beating the decliners. The troops, the people in the field, the stocks that nobody talks about are going up day in and day out, whereas in the late 90s, it was all tech all the time.
Seeing billions of dollars being put towards AI, but we're not seeing billions of dollars being put towards electricity demand. What happens if the grid can't handle all of this?
Well, that's absolutely a concern. No question about it.
Do you reach 9,000 next year if you can't even develop data centers?
That's a good question. And from our point of view, again, it's less about the synchronization of the build-out than the fact that there is sufficient liquidity to, really expect the build out to occur over a time. And again, I go back to this idea, and frankly, we're seeing it this week was different. Not only did you have the largest LBO in history, but I took taxi cab rides, and they started talking about the stock market, and they started talking about AI, and that's different, but that's part of every cycle, and that is how you get to valuations that go from rational exuberance, where we are now, to something more extreme.
I'm not throwing shade at all, but I think the cab driver over the past 5 years has been more dependable than the strategist on Wall Street in some ways. Is that fair?
We got cautious like everyone else in March. We got bullish in April, to be clear.
I'm with you. But I don't know if they've been the contrary indicator in quite the same way that they were in the 1920s, 1930s.
Well, what's fascinating, again, is you go back to February through April, and the public got this right. Literally, for the first time in the cycle, the public was the buyer the whole way down. And the reason that the market has been so unrelenting on the upside is because professionals have found themselves underinvested.
It was the shoeshine boy in the 20s. Remember all that stuff? I think the story's really different. The performance chase going into year-end is coming from Wall Street. Wouldn't you agree? From speaking to clients, they missed out on the move in April in the last 6 months. I
would, but I would also say this, is that the dynamics of trading, they used to call it day trading in the 1990s. And now you're looking at high-frequency trading, but these 0 days to expiration options, the gamma effect that causes hedgers to have to hedge upside intraday is really unlike anything I've seen.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to the Federal Reserve. Traders looking ahead to the FOMC minutes due out at 2 p.m. Eastern Time. Ian Lyngen of BMO writing 25 basis point cuts in October and December are already a foregone conclusion as long as there isn't a more dramatic downturn in risk assets. Ian joins us now for more. Ian, good morning, sir. It's good to see you.
Happy to be here.
When the Federal Reserve is in risk management mode, if they don't have the data, are they cutting or are they holding?
I think that they're going to continue to cut simply because the data shift that we saw over the course of the summer, including the benchmark revisions on the jobs front, suggests that we are cooling as an economy, and getting back to normal policy rates seems to make sense in that, with that backdrop.
I just wonder what you think of this dissonance between a labor market that seems to be cooling and GDP that seems to be going strong.
Well, as you've been discussing, the AI investment, CapEx, everything associated with that has not only been driving business spending, so keeping up the momentum of the real economy, but we are also seeing upside in equities, and that is fueling consumption because we know the top 10% account for 50% of consumption in the U.S., and I think that has been a key driver. And when I make the observation about a potential downturn in risk assets, if we are going to slip into a recession at some point, it's probably going to come from a repricing of risk assets, but that certainly is not on no one's radar at this point.
I guess that I'm trying to understand whether it makes sense for the Fed to cut rates to protect jobs, given the fact that there is clearly a sluggishness to the labor market. You're seeing peripheral spending data showing a slowdown in September as well. I was looking at Citigroup data this morning. I just wonder if it makes sense to do that if you potentially pose the risk of turbocharging what some people are saying is bubblicious types of behavior in other sectors, AI being one of them?
Well, I think that that's what the Fed needs to decide over the course of the rest of the year, whether they're going to get back to 3% or 3.5, depending on what estimates you look at, or is there a risk that there's still more to be seen on the tariff side, even setting aside the bubble issue? I still think that there's tariff pass-through to inflation that has yet to be realized, and so we could see some sticky CPI prints when we finally get them, and that's the big unknown, is when does the government start publishing data again?
So what are you tracking right now, given the fact that we're not really getting anything official from a lot of the sources?
So I think that we do have ADP and we have ISM and we have some of the private data, but at the end of the day, we're really just looking at the day count of the shutdown, because the longer it goes, the more uncertainty there'll be. And when the Fed meets later this month, the one piece of information that they will really have is whether or not the government has been reopened or if we're going to push that record-long 34-day shutdown window.
Do you guys have a base case of how long you think the government shutdown will last?
I think that it will get through the end of next week, and at the earliest before we start to see any movement, because at that point people will stop getting paychecks. I assume that there'll be more rhetoric and more headlines out of Washington. But it's also a question of how the Democrats are going to be polling as a result of this, going into what will be the run-up to the midterm and the politics around that, and that's always difficult to estimate.
So the Fed will be walking in potentially with that base case, with a jobs report, but not inflation data. How concerning is that when the likes of Neil Kashkari are sounding alarms on too fast of interest rate cuts might be a problem and there's stagflationary fears?
I do think that if they happen to have the jobs data in hand, that will be part of the story that they can justify cutting for, because a weaker job market is disinflationary on a forward basis, and that is, again, information. I do think it would be ideal if they had a full set of information, but at the end of the day, they're going to adjust to the reality as it comes in.
Ian, since the Fed last met mid-September, 2-year bond yields are slightly higher, 10-year bond yields are higher, the whole curve has shifted higher. What do you think that speaks to?
I think we're just in a range consolidation mode for the market. I think that we now know the direction of travel of rates. We have some uncertainty associated with the shutdown and what that means more than likely for the beginning of next year as opposed to the balance of this year. And we don't have enough convincing evidence to get back to 395 10-year yields, but also not to get back to 450. We're just in a range as we see how things play out.
Don't you think also that the rate story has stabilized because subsequently after the Fed meeting, we found out this Fed is far more divided than was actually revealed in that news conference with Chairman Powell, that maybe for a lot of people, they thought this was the start of a bigger rate cutting cycle, something down towards 3 and quickly. And what I've heard subsequently since is a bunch of Fed speakers with very different views about the future. Anne-Marie mentioned Neil Kashkari. There are some individuals that aren't ready to go again. Never mind go another 100. Isn't that part of this story as well? How big a feature is that?
Well, I think that what the futures market is telling us is we're comfortable with a glide path back to 3% sometime in the middle of next year. But as you point out, there are competing voices on the committee, and there do tend to be competing voices when we're at an inflection point, and we were at an inflection point. I think that Powell's comments in particular were an effort to ensure that there was as much flexibility as possible, and he didn't want to pre-commit to an October or a December move. So I think it's more of a business as usual than it is something particularly frightening.
This is sort of a perverse question, but it looks like right now in poly markets, there's only a 25% chance that the shutdown ends before October 15th. You said that this is the one piece of data that the Fed is going to have that's new, which is how long the shutdown's going on. Is that bond positive?
At the end of the day, I think it is, because it's more uncertainty, and we've spent a lot of the last 4 or 5 months with trade war-related uncertainty, as well as now shutdown-related uncertainty, and that has led to a stalling out on the labor front. And until we have more clarity, I think people are going to be a lot more reluctant to hire, more reluctant to spend, and I think that's going to eventually be bond positive.
Stay with us. More Bloomberg surveillance coming up after this. The analyst David Deckelbaum of TD Cowen covers some of the companies the Trump administration has invested in and has this to say: investors have to ask, who's next? Stocks are moving fantastically on this news, no matter what the actual details are. David joins us now for more. David, good morning.
Good morning. Thanks for having me.
Your job has changed.
It has changed indeed, sure.
The White House is now picking the winners.
Yep.
How does that change your approach?
Similar to my comments before, it was interesting. In your prior conversation, you were talking about, what's the process behind all of this and what's the intention. And I think really it's for the administration, one, to some extent, to make an investment on behalf of taxpayers, but also I think to raise the profile for the general investing public that these companies are a priority and that these industries are a priority. And now everyone obviously has their hands out, and you've seen companies openly talking about and disclosing we're having conversations with the USDO, Department of War, we're having conversations with the Pentagon, and I think it just sets the stage for what should be triggering a multi-year investment process in the broader material sector.
Theoretically, a lot of people could get behind this, and it seems like it does make sense, at least according to both sides of the aisle and what they've put out there. Is the administration picking the right names?
So I would say with their first investment, I'm not going to speak on Intel. So let's look at MP Materials, right? They're the largest rare earth miner in the Western Hemisphere. I think that was a very logical chosen champion for this administration to get behind because it unlocks multiple parts of the supply chain for rare earths and ultimately magnets. You also saw a follow-up deal with Apple right on the heels of that. So I think all of these things were connected. In the context with Lithium Americas, the government was already involved with a substantial loan that the DOE had approved under the Biden administration under the ATVM loan program, which sought to really propel the lithium supply chain in North America, largely around the proliferation of electric vehicles. We've walked back a lot of the EV tax credits and incentives there, but I think there was still partly a recognition on the part of the government that we're already in bed with this company from a loan process. Let's sort of rework some of the terms. Did it actually improve the outlook for Lithium Americas? I would argue perhaps no. It really just diluted really diluted the equity holder at that point. But it does obviously raise the profile, and the stock moved up well over 100%, without really caring what the details were.
So can you just basically look at whoever the U.S. has given a loan to and say that probably will be equitized?
Sure, you could certainly build. I mean, you've seen a lot of names already moving in anticipation that they're going to receive funding in some form. And logically, you would anticipate that every single company in the materials space that has a project, at least on the whiteboard at this moment, is having active conversations. So I think you can probably still make money that way because at some point you have to ask, how does this all end? Is the government going to be trading out of these equity positions? It's not as though there's always a contribution that's coming with this. And at this point, I think it's safe to say that there is no end in sight for this.
Well, some people think that this is just the beginning of potentially U.S. sovereign wealth fund.
Sure.
Is that how you view it?
I mean, I think in some cases that's already very much the case, except, in theory, I suppose this is being done with taxpayer money. And you've seen some funds reallocated from areas like the CHIPS Act and some other funding. And I think it's really just going to try to accelerate a lot of these investment opportunities.
One official was talking about there's hundreds of deals that right now are being proposed. Yep. Could you see by the end of Trump's first term, hundreds of companies the U.S. government has a stake in?
In theory, sure. Look at all these stakes. And what's interesting about a 5 to 10% stake is some of these are coming with board membership, right? So the government is becoming an active member of management oversight, right? They're not necessarily helping with execution, but they can help on the contracting side. And if you think about, hundreds of companies out there taking a 5% equity interest in some of these companies that's coming costless to the government, sure, in theory, right? And if you're an executive right now and you see the potential to re-rate your equity by hundreds of percent, and then on the back of that, perhaps raise additional capital in the markets, just by giving the company, the government 5% of your company, that's a very difficult deal not to sign.
But long term, what does this do for competition in this space?
Well, I think that it does welcome, at least in the United States, that everyone can get involved in the supply chain. Look at rare earths, for instance, right now. Yes, they've championed MP. They've given them a floor price. And you've seen actually the NdPr market for rare earths, you've seen pricing move substantially higher, up to $90 a kilo. In August, they gave them $110 a kilo price floor. I think that it provides opportunity for everyone within the United States and really allied nations to come forward with projects to try to reshore the supply chain as quickly as possible.
Stay with us. More Bloomberg surveillance coming up after this. Greg Daco of EY raising his rate cut bet, now expecting the Fed to lower interest rate at back-to-back meetings. Greg writing the following: this increasingly fragile backdrop, compounded by a data vacuum and policy uncertainty, is likely to tilt the balance of Fed policymakers. Greg joins us now for more. Greg, good morning.
Good morning.
No data, no problem?
No data means more caution when it comes to how business leaders, how economists, how Fed policymakers are going to react. I've been talking with a lot of business executives that are concerned about the fact that we're not getting a pulse on the economy. And as we were getting before this government shutdown, a lot of mixed signals. There's growing uncertainty as to the underlying pace of the economy. I think one thing that's key to remember is that there are three fragile pillars to the economy that all start with an A. You have essentially affluent workers that are supporting consumer spending. You have the AI investment boom and potentially a bubble there. And then you have the asset price increases. They're all correlated and they're all fragile. If you get any type of disruption to one of those three, that could portend to a slower economic outlook and then the need for more Fed easing as we navigate into 2026.
When you talk about caution, it seems to be a deceleration in growth or euphoria in markets, not necessarily the acceleration in inflation. Why?
Well, I think when you're thinking about the economy right now, what you're seeing is essentially the acceleration in inflation that is induced by tariffs. And the key question is whether this is an embedded acceleration in inflation or something that's likely to be transitory. And you and I have talked about this in the past. We are in an environment where labor market demand is softening. It's not because we're seeing slower payroll growth only. It's because we're seeing a hiring rate that's at a 12-year low. It's because we are seeing continuing claims for unemployment that have been gradually rising. It's because job cut announcements are up 55% relative to last year. So all of these indicators indicate softening labor market demand. Notwithstanding the massive negative shock that we've seen in terms of net migration, there is underlying weakness and softness in the labor market, which means there's unlikely to be this desire to raise wages. And so what we're seeing is essentially this increase in prices, which is eroding consumer spending power. And in turn, businesses that have to contend with these higher cost pressures are not going to be hiring more freely. They're not going to be allowing for higher wages, and therefore that's going to continue to weigh on income and on consumer spending activity.
There's a lot to unpack there. I just would ask, and I sound like a broken record because I ask this a lot, would really cutting rates help that picture in any way? Would it get people jobs, given the fact that ultimately a lot of companies are turning to AI and they have every capital market opening that they possibly could imagine?
I think that's the broader question as to how the Fed reacts to supply shocks. We are in this environment where what we're seeing is massive supply shocks to the economy, whether it's on the side of AI or on the side of net migration in the labor market. The Fed has a limited number of tools to address any type of imbalance in the economy. And in this instance, it's a supply shock that's leading to inflationary pressures and reduced growth volumes. Now, your question is very interesting because what we're seeing is essentially a growing spread between short-term rates and long-term rates. Short-term rates are pricing more Fed easing over the course of the next 12 months. Long-term rates have to contend with higher inflation expectations, a fiscal situation that is concerning, even more so in the midst of a government shutdown, and then Fed pressures from the administration. The three Fs there are very important to contend with when it comes to the trajectory of where the economy is going to head.
When you look at tariff-induced inflation, though, we haven't really seen it yet. Not broad-based.
Not broad-based, but if you lift the hood and you look at the underlying drivers of inflation, if you look at grocery prices, if you look at apparel prices, if you look at car prices, if you look at furniture prices, all of these elements have been rising and lifting inflation by about a third. Essentially, a third of the inflation increase over the course of the past 4 months has been driven by these categories. What I would also note is that you're also seeing that pass through to services. A lot of services that we consume are actually using goods and equipment. You think of medical care, you think of car repair shops. There are services that use a lot of equipment that have an imported component into them and that essentially see these upward pressures in terms of prices. We're not going to see the same type of increase that we saw back in 21 and 22. We're not going back to 9% inflation, but we are going away from 2% inflation towards 3.5% inflation, which is hurting families across the country.
Will this haunt the Fed next year? Because they seem to be ignoring it completely in the biases to the labor market.
I think you may see the hints of this hurting the Fed next year because the rotation of voters is going to be more hawkish. So if there is more easing this year, you're going to see more hawkish members next year that may be on the docket saying essentially we ease too much and we now need to either hold for longer or tighten monetary policy. That's going to be the 2026 debate because the rotation of Fed policymakers is going to become more hawkish.
It's super hard to predict what the Fed's going to do a year out. The Federal Reserve has difficulty predicting what the Federal Reserve's going to do a year out. Given what you just said, you're going to have this mix, this collision between a hawkish rotation and then maybe a very dovish rotation at the very top of the central bank. How difficult will this committee be to lead beyond May next year?
Extreme polarization is going to be the situation when it comes to the Fed. We're already seeing hints of that. There's 150 basis points spread between the most hawkish dot in the infamous dot plot of the Fed and the most dovish policymaker. So that polarization is going to remain firmly in place, and we're going to get a cacophony of speeches that go in different directions when it comes to interpreting the direction of the U.S. economy next year, and that's going to be very hard to read from a policymaker standpoint, but also from a business leader standpoint. Let's not forget, what we really are concerned about is the direction of investment, the direction of employment, and the direction of consumer spending. If you have a lack of clarity as to what the Fed's going to be doing, because it interprets conditions as either being extremely loose on the financial front, or because it sees that there's more of a drag from the labor demand side or labor supply side, whether there are different views, diverging views, very divergent views potentially, that's going to confuse policymakers, it's going to confuse investors, and it's going to confuse business executives as to what decisions they should make.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.